Hey guys, Happy New Year and welcome back to Andrew Invests. This year, I'll be making radical changes to my portfolio based on my investment strategy that I will be sharing with you guys today. When you invest, I think it's important to understand the growth story of a company and the financials. So today, I want to be going through the 3 stocks that I'm buying at the moment in order to beat the market in 2024. Those are Netflix, Google, and Meta. Let's start off with the growth story at Netflix. Netflix is already the largest paid for streaming service in the world, and it has 250 million global subscribers. And in my opinion, it's already won the streaming wars. But if it's won the streaming wars and it's already the biggest service, then where is the growth going to come from? The answer lies in the streaming business itself. I think as a relatively young person, it's really easy to forget that people actually still watch linear broadcast TV or even pay for cable packages. In my age group, everyone is streaming their content and TV. So that leaves a huge avenue for growth. If you actually look at the statistics for the US alone, which is further ahead than many other countries in terms of its streaming progress versus linear TV, only 37.5% of total TV viewing hours is from streaming. The rest is from linear broadcast TV or cable TV. But investing is not only about finding revenue growth in a company, it's about finding companies that can turn revenue growth into profits. And Netflix is the only streaming service that has consistently shown that it's able to do so. When you look at some of its rivals like Disney or Paramount, every time they gain a subscriber on their loss-making streaming services, they lose a subscriber on their highly profitable cable business. And that's a problem that Netflix simply doesn't have to deal with. Personally, I think some of its rivals are going to go bankrupt over the next few years, which will allow Netflix to continue to consolidate the streaming market and only gain more market share. Now let's look at the company's financials. So Netflix might seem optically expensive sitting at a 48 price to earnings ratio, but that's based on the previous 12 months of earnings and overlaps with the pretty poor Q4 in 2022 that the company had. When you actually look at the forward price to earnings ratio, it's sitting at only 30. That takes into account analysts' expectations for the growth in profit of Netflix. And that's extremely reasonable, especially when this company is sitting at 14% growth rates in revenue for 2024. At 14%, Netflix's revenue growth rate for 2024 is not that far off its 5-year average. And I don't think it's inconceivable that the company could continue to grow at that rate for the years to come. I personally think that the company is in line to re-accelerate its growth after the disappointing last year for the reasons I mentioned previously with declining cable businesses and so on. I also really like Netflix's net debt position when I look at its financials. It only has around $6 billion in net debt, and when you compare that to other companies in the same business like Disney or Warner Bros, they nearly have 10 times as much debt. When I look at a discounted cash flow analysis for Netflix, the numbers are extremely impressive. Even if I plug in an 8% revenue growth rate, which is a lot lower than what I think the company will grow at, and the historical EBITDA margin of 63% and a capex margin of 1.2% and discount it by 10%, the company has huge upside, with it currently being valued at $486 per share and the fair value being $782. If I plug in numbers of what I actually expect the revenue growth rate to be over the next 10 years or so, around 10 to 12%, the company becomes even more undervalued. Let's move on to Google's growth story. Now, Google has had an absolutely amazing year in terms of its share price, but it's also struggled with a whole host of legal issues. One of the main ones being whether its choice to pay Apple billions every year to have default status as a search engine on the Safari browser on iPhones is anti-competitive. Personally, I don't think that the outcome of this case will be that bad for Google, as personally I see the competitive issue here being with the ability of Apple to sell that status in the first place. It's not an issue of whether Google should be allowed to buy it, but whether Apple should be allowed to sell it. I think the most likely outcome is that Apple is forced to not be able to sell it and provide users with the choice to set their default, in which case I think most people will choose Google. Another issue that has been hanging over the head of Google this year has been competition from ChatGPT. Investors have been worried that Google's lucrative search business would be under threat from ChatGPT, but now having had the whole year to actually use ChatGPT, I don't think that this will be the case. I think that the service has very specific use cases involving asking it to perform specific tasks for you, but I don't think it really actually overlaps with searching for things to buy or advertising in general. So I personally think that Google's search business is safe from the AI threat, and I think it will be lucrative for the years to come. So a lot of the undervaluation of Google's stock right now because of this can be pretty much dismissed in my opinion. I also really like the potential of Google Cloud and YouTube for pushing revenue growth at Google over the coming years. Google Cloud has struggled with declining revenue growth this year, but they're still at extremely high rates in the high teens, and I don't think it's going to slow down much more than that over the years to come. In addition to that, I mentioned previously that YouTube is pretty much the only streaming competition that is on par with Netflix, and so it has extreme room to grow just like Netflix. And I also think that the company has struggled with making YouTube profitable in the past, but this could be the year that that happens, with the company cracking down on ad blockers and potentially encouraging more people to subscribe to YouTube Premium in the future. Looking at Google's financial metrics and valuation, this is where I think the stock excels, and it's sitting at around a 21 forward price to earnings ratio, which is pretty much the lowest of all the big tech companies and what I think makes the company very attractive as an investment. The company has had slowing revenue growth over the last couple of years, but I do think there's potential for this to re-accelerate, just as other big tech companies are starting to do. Finally, let's talk about the growth story of Meta. Meta's apps, Instagram and Facebook, were long thought dead, and they were thought to have been killed off by TikTok. But actually, by the end of the year, these apps are growing at a faster rate than TikTok, and it's a triumph for the company. It's also seen a relatively successful release of its Twitter killer app, Threads. Now, Threads had a bit of a disappointing drop-off in users after its initial success, but it's since been actually steadily growing in pace, and I don't think that's a coincidence. One of the things that Meta has been extremely good at in the past is generating content from users without even actually having to pay them. When you look at YouTube or even Twitter, they're actually having to pay their users a share of the ad revenue that they generate in order to get the users to continue posting. But Meta has somehow actually managed to get away without doing so and take all of the profits for itself. So whilst the ethics of this may be questionable, Meta's business model is fantastic as an investor. I personally see advertising revenue only continuing to increase for Meta and Google over the coming years as advertising revenue moves away from traditional media to social media. The only black spot on Meta's report is probably its metaverse and virtual reality division. But I have seen really encouraging signs with the technology for the Oculus or Meta Quest, and I do see potential for it in the future. Even ignoring it entirely, the company is on a great growth path, and if virtual reality actually succeeds, that's only going to make the company's share price explode. If it fails, I don't think it will actually make the company's share price go down by that much. Moving on to Meta's financials, I think that the company's valuation is one of the most attractive things about the stock. It's sitting at less than 21 in terms of its forward price to earnings ratio, which is very similar to Google and doesn't really show that the company is actually still growing at a pretty rapid rate. So I think that the company is still undervalued even in spite of its massive rally through 2023. The only black spot that I would put on Meta's financials is that it has stopped doing share buybacks, and the share count is actually starting to slowly increase again due to employee stock-based compensation. I don't think it's a coincidence that for these three stocks, they're actually trading at a share price which is below their pandemic highs. They've continued to grow their revenue whilst the share price has actually traded down, and I think that's a great opportunity to buy them at undervalued prices. Personally, for me, I'm going to be spending my money primarily into Netflix stock, Google stock secondarily, and probably a little to zero of Meta because my Meta position is already extremely large and I already have a lot of stake in the company. So let me know what you guys think about my investing method, what you think about these three companies, and what you'll be investing in this year. If you enjoyed the video, please leave me a like and subscribe, and I'll see you guys next time.